Hello, everyone. Today we're going to do chapter 7 of our textbook, and it deals with interest rates and bond valuation. And basically what's going to happen, and I'm now going to minimize my video, and basically what's going to happen is we are going to apply what we learned in chapter 5 and 6 on a particular instrument in finance, and that is bonds that are issued by companies. So let's begin, and let's first define what bonds are. So let me make this a little bigger. So bonds essentially are loans that are made by corporations. It should not say loans to corporations, but they're made by corporations. And in other words, it's basically a form of debt. So most companies can either go to the bank and borrow the money, or they can issue bonds. Let me put it in perspective by opening up my Word document. And just to refresh your memory, because we did do some of that in the last class, or at least I discussed when we were in chapter 1 over the scope of this particular class. So in a sense, this is the story. So if you recall, we have current assets on this side, and then we have fixed assets on this one. These are mostly for manufacturing firms. Then we have current liabilities. And then we have two forms of debt. The one are bonds. It doesn't look like bonds. And one is stocks. So these two are what we call the long-term capital of a company. And they are there for a long time, so you don't have to worry about short-term loans or anything like that at that point. Now, within current liabilities, if you remember, there is notes payable, but those are short-term loans from banks, usually less than 1 year, and they don't count as debt because they're part of the current assets and not part of the long-term, current liabilities and not as part of the long-term liabilities. So chapter 7 will deal with bonds, and chapter 8 will deal with stocks. So both refers to the long-term capital of a company. Now, one thing you might want to note is the difference, for example, between bonds and bank debt. So in the US, most of the large companies, most of the large companies are able to borrow through the bond market. And why is that? Well, because it'll end up being cheaper to them. So if you're a small company and you just started a business, the chances are very good that your debt is coming through banks. So that will be for small companies. Now, for large companies, they will issue bonds in the market, let's say $10 million. And the people who arrange for them are usually investment banks, such as Merrill Lynch, Goldman Sachs, Morgan Stanley, because what they're doing is when you're borrowing from a bank, you're borrowing from one entity, ABC Bank, right? And it's a one-on-one relationship when you borrow from a bank. But when you go to issue a bond, who are you borrowing it from? Well, you're borrowing it from the public, and there are thousands of them, each lending certain amount by purchasing your bond. And so you need a middle person to arrange. And so let's say it's Morgan Stanley. Morgan Stanley can do a good job because they have a very efficient network of broker dealers around the country that can have access to investors. So basically what they say is, listen, here is ABC company. they want to borrow $10 million and they'll give so-and-so interest. Will you be interested in lending to the company? Okay, so that's the picture. But because it's held by so many different people in the public, the characteristics and the rules that govern a bond are slightly different than when you borrow, let's say, 10 million directly from a bank and say, which basically is, 10 million, which basically is a one-on-one relationship. One of the things about that is that, let's say, bank, I'm talking about this company, wants to borrow, let's make it a smaller amount, 1 million. And it goes and borrows from the bank, and the bank says, sure, I'll lend it to you and I'll charge you 10%. Let's say just before lending, the bank says, you know what, I think the interest rates have gone up, so I should charge a higher rate. So if it's not a fixed term loan, then what will happen is it's very easy for the bank to change the contract and say, okay, next year when you're full, we can charge you 11% instead of 10%. It depends on whether you're at fixed rate or not. But when you borrow from banks, from the bond market, sorry, so if you're borrowing bonds from the public, what happens when interest rate changes? And so if you wanted to buy a bond, and let's say the company was giving you 10%, but you say, I don't want to lend to the company at 10%, I want to charge 12%. Well, you can do it. And the way you do it is by paying less for a bond. And that's what we're going to learn in this chapter. Okay? So if you go through my notes, I give a very simple example that says, look, if you're a bank and you want to charge 10%, and it's a 2-year loan, let's say, and the loan is $100. Well, then you just charge 10, and then the principal back of 100. If you have to change the rate, you do the same thing, 12, and then the 100. But with the bond, you're giving it to so many different people, it works the other way around. The bank will say, the company will say, listen, I want to borrow some money from you. I'm willing to give you 10 and 10 interest, and then I'll pay you the loan amount, which we call the face value, back at 100. It then asks you, how much will you be willing to pay for it? So if you say, I'm happy with 10%, then of course you'll lend at 100, but then you'll get 10, 10, and 100 back. But let's say you want to have charged the company 12%. What can you do then? Well, what you can do is you can pay a lower amount. And the lower amount is going to be exactly what we learned in the last class. We're going to find the present value of this and this. So if you put 10 as my payment, there are 2 10s, remember. There's a 10 and then there's 100. 100 is the future value because it's one number. 10 is 2 payments, equal payments. 2 is the end, so put 2 of these 10s down. And you said you wanted 12%, so 12 plus interest per year. And then if you type compute present value, guess what you get? You get $96.62. Excuse me. So if you give IBM, let's say this company is IBM, you give $96.62 to IBM, and IBM gives you 10 in the first year, 10 in the second year, and 100 back, then you're earning 12%. But of course, at this point, grandmother walks into the room and says, I don't believe you're getting 12% for that. So again, we use the same technique. How will we prove it to grandmother? We'll say, grandmother, listen, if you had $96.62 and you don't want to give it to IBM, what will you do with it? You'll put it in a bank, correct? All right, let's say the bank gives you 12%. How much will you have at the end of the 2 years? So that's easy. That's finding the future value of 96.62 at 12. So you can do it the easy way. You don't have to use the calculator. You can just, use the calculator, but you can use the formula. You multiply it by 1.12 and then 1.12 again. And it turns out, if you had 96.62 in the bank, it'll equal to 121.20. Now, let's say instead you give the 96.62 to IBM. They'll give you 10, then 10, and 100 back. When you get this first 10, let's say you put it at an interest rate of 12%. So how much interest will you get? Well, I'll multiply 10 times 1.12, and that will end up being 1120. So 110, 1120 adds up, guess what? 121.20. So basically you'll be telling grandmother, indeed, I'm getting 96, when I give 96.62 to IBM, and they promise to pay me 10, 10, and 100, I am making 20, or I am lending at 12%. Because if not, because otherwise if I put it in the bank and I put it at 12% for 2 years, I'll get 121.20. Or if I lend it to IBM, they'll give me 10, then they'll give me 110 back. If I put the 10 in a bank that earns 12% interest, it becomes 1120, so lo and presto, 121.20. Same thing as if I had put in a bank. Hope that sets the stage to understand the difference between a bond and a bank debt. So now let's do some more formal analysis on the bond market. Okay, I just wanted to make sure that I was recording at this point. Okay. So there are 5 terms we need to know, and they all correspond to those 5 buttons on your calculator. That is, for when you want to know the price of how to price a bond or what interest rate you're earning on a bond, etc., you have to have these 5 information, or rather you need the 4 information and they compute the 5th. First is the face value, which is what is the face value of the loan. Now, you can use any face value, but essentially, we use in this textbook, and most textbooks use $1,000 as the face value. But you can use it as $1 million, etc. It doesn't matter. And that 1,000, when you use in the calculator, you'll be pressing the FV button. Now, the important thing to remember is there's 2 interest rates. One is called the coupon rate, and this is the rate that is paid by the company. So in our example, it was 10 before, right? That was 10%. That's called the coupon rate, and it will be multiplied by the face value. So if IBM says, listen, I would like to borrow from you some money, and I will pay you 8% annually. The default of 1,000 face value means it's 8% times 80, they'll pay 80 per year. The maturity is simple. IBM can say, lend it to me for 5 years, 10 years, 15 years. The next is the yield to maturity. This is what you demand. So we call that the yield that you earn till maturity. And this is what you'll put in for your interest per year on your calculator. So there's an interest that they pay, which is fixed, and then what you demand can change. And finally, if you find the present value, we get the price of the bond. Okay, one other thing to note is in the textbook too, that when we say bondholders, creditors, they basically mean the same thing. Sometimes we'll call them creditors, but basically bondholders are creditors, they're lending money. If you're a bondholder, you're lending money to a company. So let's take one example. Suppose IBM decides to issue a 5-year bond and it's worth about 10 million. In other words, they want to borrow 10 million for you. They plan to pay an annual coupon of 8%. The market, which is you think 8% is too low. You think you'll demand a 10% return because the interest rates are high on this group of bonds. So let's first find out how much you'll pay for the bond. So first we draw the timeline. And how does the timeline payments look with the timeline? Well, IBM will pay 8%, they said, so they'll pay 80, 80, 80, 80, 80, and then the face value is 1,000. If we had used 100 as our face value, then this would have been 8, 8, 8, 8, 8. But most textbooks use 1,000 as the face value. Now, how do we find the present value? Well, let's see. We said we demand 10%. So 80 will be your payment. 1,000 will be your future value. 5 is the N. 10 is what you are demanding, is your interest per year. And if you type in the present value, 924. So you will pay 924 in order to earn 10%. And if grandmother says, prove it to me, you'll do the same thing like you did before. You'll tell grandmother to put this 924.18 in a bank, see how much it grows in year 5. Alternatively, do 80, 80, 80, 80, 80, which you'll get from IBM, put it in a bank, earning 10%, and the numbers will turn out to be the same. Now, what happens if you ask 8% and you're happy with 8% with IBM? So all your change now is the interest per year will become 8%. Compute the present value, and guess what? It'll be exactly equal to 1,000. And that makes sense, correct? IBM is giving 8%. You want 8%, so you're happy with $80 interest per year. Now, what happens if you say, IBM is a great firm. I'm actually happy with 6%. I know they're giving me 8%. So 80 is their payment, 1,000 is the future value, 5 is the N, 6 is the interest per year. Guess what? The price is actually, you'll be willing to pay more for IBM because you are happy with 6%. And the logic is still the same, 108,420. The logic is still the same when it comes. You are willing to pay 108.4.25 to buy from IBM, because IBM is giving 80, 80, 80, 80, sorry, I should do it here, 80, 80, and 1,000. Well, are you making 10%? 6%? Let's check. If you had put it in a bank at 6%, let's see how much you will get it at. Any calculator? I'll have negative 108.4.25 is my present value. 5 is my N. 6 is my interest per year. 0 is my payment. Compute future value. So let's see what I get. 1084.25, change sign, present value. 5 is my N, 6 is my I, 0 is my payment, compute future value. I would get 1,450.97. So you put it in a bank at 6%. That's how much you'll have at the end of 5 years. Alternatively, you give it to IBM. Let's say you don't get 6%, you get 5%. So let me try and get 6%. So IBM will give you 80, 80, 80, 80, 80, and then 1,000. Let's see what that amounts to at 6%. So there's a shortcut to do it. We can take all this 80 in one shot to over here. So what will we do? We'll say 80 negative is my payment, 0 is my present value, 6 is my interest per year, 5 is my N. So let's try that. 80 is my payment, 0 is my present value, 6 is my I, 5 is my N. Compute future value. Guess what? It is 450.97. So all of these 80s, so let me just take this out. So all of this 80s will total up to 450.97. Then IBM will give me my 1,000. So I'll get 1,450, so 97. So this is the right price. I either put it in a bank at 6% or I give it to IBM. And by giving it at 108,425, I'm actually making 6%. The important thing to remember is, therefore, the rule is very simple. And let me see if I mentioned it here. Yeah, it's in this one. If the coupon rate, what IBM is paying, is lower than what you demand, that is, you demand more, then you're going to pay less than 1,000 for the bond because you're demanding a higher interest rate. So what we say is that this bond will sell at a discount, or the bond is selling at a discount. If the coupon rate is 8 and you demand 8, then the bond will trade at face value or par value because it's exactly equal to the face value, so you're willing to pay 1,000 too. Now, if the coupon rate is 8% and you demand a lower return, then we say the bond will trade above the face value, or sometimes referred to as trade at a premium, and the premium being the face value is 1,000, but you're willing to pay more, or investors are willing to pay more. So that rule you need to understand for this class. The higher the rate you demand, if it's greater than the coupon, you'll pay less than 1,000. If you demand less than what the company is paying, you'll be willing to pay more than 1,000 of the face value of the bond. And if you're demanding the same as what the company is paying, then the bond will sell at par at face value at that point. Okay. Now, so that's the relationship we call between the yield, between what you demand and the price of the bond. So once again, we repeat, if you are demanding a higher rate than what the company is giving, the price of the bond will be lower than the face value, which in this class, it'll always be 1,000. If the coupon rate is the same as the rate that the company is paying, so if the coupon rate is the same as what you demand, yield to maturity, it will sell at par or 1,000. If the coupon rate is higher than what you demand, obviously it will sell at a premium at that point. Now we want to look at another relationship, and that is the relationship between maturity and price. So let's take a look, and let me draw this in a different way. So what we did is we said, listen, we have a 5-year bond. It's paying 80, 80, 80, 80, and 80. And let's say you demand yield to maturity of 10%. Now remember, the coupon, what the company is paying is 8%. So obviously we know the answer. It will sell for less than 1,000. So when we take the present value of all that, we already came to a price. And what was the price? The price was 2 slides before, 924.18. So the slide, you're willing to pay 924.18. Now let's say you buy the bond, and then a year passes by, and now you are here, and you decide you want to sell the bond. So the person who's buying from you says, oh, now it's a 4-year bond. So let me see what the price is. I'll try to bring the present value of all this back because the company, I can expect the company to pay me 80, 80, 80, 80, and then 1,000. So how will you do it? You'll say 80 is my payment, 1,000 is my future value, 4 is my N, 10 is what I'm demanding, compute present value, and lower. So what do you get? You get at 4% 936.60. So a year later, the price will be 936.60. Let's say we do the same thing after another year. So this time you receive 3 80s and 1,000, and the price will be 950.26. 950.26. And then a year later, it's 965.81. So this is right there. $965.29. $965.29. A year later, it's 1 year left. Oh, clicking the wrong thing. Bring this here. It'll be 981.82. 981.82. So of course, at maturity, it'll be 1,000. So what do you notice in this price? As you approach maturity, what happens to the price of the bond? Because it's selling at a discount, price continues to increase towards the face value of $1,000. Do you see that? It's getting, if you sell it a year, you'll get it 936. If you sell it 2 years later, you'll get 950, 965, 985, because you're getting that 1,000 back, right? So you'll obviously start heading towards 1,000, because that's what whoever is owning the last will get that money. What about if you had the IBM coupon rate is 6%, sorry, 8%, and you demanded 6%. So you say, all right, I already did that calculation. Let me see. That was 1084.25. So when it's 80, 80, 80, and 1,000, and I take all of these back to find the present value, I get 1084.25. But now what we want to know is what happens a year later. So a year later, you are standing here. This 80 is gone because you already took it. Now you want to sell the bond. So there's somebody there that said, okay, I've got 4 80s coming to me, and then I'm demanding 6%. What should be the price of the bond? Well, it turns out it will be right here, 1069.30. So it'll be 1069.30. So now what I'm going to do is I'm going to calculate it for each year as you approach maturity. You probably take a guess what's going to happen. So, sorry, let me click this. So if I now stand here and I have 3 years left, the price of the bond becomes 105.346. 346. Now, if a year later, when there's only 2 years left, and everybody's still saying 6% is a good rate, be 103.667. And finally, when there's only 1 year left, you'll sell it for 101.887. Of course, when it matures, you'll get $1,000 back. Technically, you'll get the 1,000 and the interest, but we'll ignore that for the moment. So in this example, what do you see? If it starts off at a higher price, then it starts getting smaller and lower till it hits $1,000. So the rule is this: if the bond is selling at a discount, which is 1,000, as you approach maturity, it'll head towards 1,000. If your bond is selling at a premium, which is above 1,000, as you approach towards maturity, it will start coming down towards 1,000, just like we showed in this example. And if what you demand and what the company is paying for is the same, in this case 8% and 8%, then the price will continue to remain at $1,000 at this point. Okay, so we've learned two things so far. One is the relationship between the yield to maturity and price. And here we've got the relationship, between maturity and price, not the yield to maturity. So let's move on forward and come up with the third relationship. And that has to do with the relationship between maturity and risk. And this is actually quite a simple one to explain, but let me try that. So remember, this is a relationship between maturity and risk. Let's take two bonds. One is just a 1-year bond and another is a 30-year bond. The coupon rate is 10%. So let me just draw this diagram here. So we are considering two bonds. One is a 1-year bond, so $10 because coupon is 10%. Then the face value, and I find the price of the bond here. The other is a 30-year bond. Again, 10%, so I'll get 10% of 1,000 is 100, 100, 100, 100, 100, 100, and then the face value back. So if you're looking at a 30-year bond, this is how you'll find the price. This is how you'll find the price for a 1-year bond. So just to do it here, 100 is my payment, 30 is my N, 1,000 is my future value, and now the question comes in is, what rate of return do we want to say? So let's start with 5%. So if I use 5%, then I will get is 1,768.62. Whereas with the short-term bond, I find the price value at it's 107.62. 107.62. 1,047.62. 1,047.62. Now this is at 5%. So obviously it's going to sell at a premium because they are giving you 10 and you're happy with 5. Now what happens if the bond prices, the market prices of interest rates go up and you say, oh, no, let me not file, let me demand 10%. Well, with 10%, we don't even have to do the calculations. You know the rule. They're offering 10%, you're offering 10%, so both times will sell for 1,000 at this point. Let's say interest rates goes up further and we try 15%. So now I'm going to go back to the PowerPoint. You'll see the price of this now, because it's higher rate than what they're paying, it is selling at a discount, it's come down to $957.52, whereas the 30-year bond has come down to $671.70. So the interest rates, as they go up, you know the prices come down. What if it goes up as high as 20%? Well, if it goes up at 20% and you redo the number, you'll see that the price will come down to $916.67, whereas the 30-year bond will come down to $502. But what we are looking at is, and when you look at this, is a C in the terms in terms of volatility. Take a look at this one-year bond. When interest rates swung between 5 and 20%, that's a large increase. At 5%, your bond was selling at 107.62, but at 20%, even if it shoots up as high as 20, it's coming down only to 916. So what's the difference? I say, okay, let's see, 1047.62 minus 916.67, about $131 difference. But what about this? If you had invested in the 30-year bonds and the interest rate went up from 5 to 20, well, 1768.62 minus 502.11, the price will fluctuate as much as 1,266.51. Obviously, which one is more riskier? Because in finance, we consider volatility as risk. So you can see that the 30-year bond is obviously much more volatile. If you had purchased it at 1768 when interest rate for 5%, and then the interest rate shoots up to 20, which, you know, as you know, we have a rising interest rate environment right now in the US, well, you would lose about 1266.51. Whereas if you had invested in the one-year bond, the most, with such a drastic increase, it never happens that high, except in certain developing countries when inflation is very high, you would have only lost $131. So the moral of the story, therefore, is that short-term bonds are less volatile and hence considered less risky. Because in finance, we consider volatility as risk. That is, we do not like too much fluctuation, so you'll be happy with a lower return than with something that is more risky at this point. So I'm going to take a quick look here at the bond price and volatility, and this is exactly what we did. You will notice that when the interest rates go up, the price of the bond comes down. So I've shown you two bonds. One is the 30-year bond and one is the one-year bond. The one-year bond is a very, very slow progression, but look at this red line. It's going to go down rapidly in this case, okay? Again, when we look at the change in the price when interest rate changes, the 30-year bond, as you can see, has fluctuated from nearly $1,800 to as low as $600 when interest rates change just 15%. That's too high a change, but still that's something to be, it just shows the extreme volatility that 30-year lending or 30-year bonds can do to your investment. So most people obviously will prefer the shorter term bonds because they fluctuate less. At this point, let's move on now to some different kinds of bonds that are there. So far, we just studied a very basic bond, but in reality, in the world, there's all kinds of bonds available, which have different features And let's start with the simple one, and it's the one that is common only in the US. And these are bonds with semi-annual coupons. So if you recall, we did annual compounding and semi-annual compounding in Chapter 6. Well, here's an instrument that uses one with semi-annual payment. So in the US, most corporate bonds pay interest semi-annually. What does that mean? As we said, well, let's take an example. Assume you have a 5-year bond that pays 10% coupon semi-annually. That means the company is paying you 10 for every 1,000, 10%, so it's $100, but it's paid in 2 lots. So every year it'll pay either in June and December, or sometimes March and September, March and September. So it'll be paying 50, 50, 50. So what changes? Well, 2 things changes. One is the N. Now you have, instead of 5 payments, you have 10 payments. As you can see, that's 10. The payment itself is halved from 100 to divided by 2. And now when we find the present value, we want, as it says, investors demand a 14% rate of return. Well, we want to take it back at 14, but since we come every 6 months, that 14 is at 7%. So that is also halved. So then we'll use 7 as my interest per year. And 1,000 is your future value. So when you compute it, the price is slightly different. It's $859.53. So the only thing that changes at this point is that we have to make sure that the payments are properly charted on the timeline and that we use the appropriate interest rates to go. So just as a repeat, whenever you have a semi-annual coupon, your payments will be divided by the number of sub-period, so that will come down. The N will increase because you'll have to know how many times. If this was quarterly, 5 times 420 would be your N. And then, of course, the yield to maturity, which is your interest per year, will also have to come down because you're doing it at shorter intervals. Now, let's do some problems, and we'll do one with the semi-annual compounding too. So far, we gave you all the information to find the price of the bond. But essentially, in your calculator, for all the 5 buttons, I could ask you to find out any one of them, whether it's the coupon rate, whether it's the maturity, etc. Let's take this example. You have a 6-year bond that is paying 8% annual coupon, and it's selling for $955.14. So let's try this. It's an annual coupon, not a straight line. 4, 5, 6, and it is paying a coupon of 8% and $955.14. So what we are saying is that the coupons, the company is willing to pay 60, 60, 60 for every 1,000. Now, instead of finding the price, I'm already telling you that the price has been determined by investors in the market, and it's $914. So the question asked this time is slightly different. It is saying, what rate of return are investors demanding for this bond? So now it's the other way around. We want to find out how much they must be demanding, or how much you are demanding, in order for you to be willing to pay $955.14. Now let's start one thing. The company is paying 6%. We know that if you had demanded, or the market had demanded 6%, what will be the price of the bond? We know the bond will sell at par, so it'll be $1,000. But it is selling at a higher rate, so obviously that means that they must be demanding a higher rate because they are only going to pay less than $1,000 for the bond. So in that case, how do we calculate it? Well, calculating it is very easy because we have to use 4 of the 5 buttons in your calculator. So it'll be 60 is your payment. It's annual coupon, so 6 is your N. Negative 955.14 is your present value. 1,000 is your future value. Compute interest per year. And if you do that, and let me do it, 955.14, 1,000 is your future value, 60 is the payment, and what else do I have to put in? 1,000 is the future value. Did I put that in? 6 is the N. Compute interest per year, and I have 6.939. Let me just double check. Oh, I must have made a mistake. Sorry. See, that must be my dyslexia. It should be 80 and 80 and 80. What am I doing? 80, 80, 80, 80. It's 8% is the coupon. So obviously it has to be higher than 8%. So I'm going to change that. In the calculator, you don't have to do much. Just put 80 as your payment. The others will remain there. Compute interest per year, and you have exactly 9%. So what does it mean? It means that the market or you buying the bonds said, I need 9%, so that the yield to maturity is greater than the coupon rate. Let's do another example. Assume a 10-year bond is paying 16% coupon semi-annually. So let me just write that down. So that's a 10-year bond, but the interest being paid is semi-annually. So this will be 1.5. Not doing a good job. 2, etc. And obviously this will be 20. This will be 19.5. This will be 19. And the interest is 16%, so 16% of 1,000 is 160, but since it's being paid semi-annually, it'll be 80, 80, 80. 80, 80, and 80. So 80 is our payment, 20 is our N. We got 20 of that. Let's see what the question asks. It is trading right now at 1105.94. So all of this, when you take the present value, is 1105.94. And we have to put the 1,000 over here. So now the question is it asking for the interest rate? And the answer is yes. I didn't put it down here, but the question is asking what interest rate is the market demanding. So we are going to say 80 is the payment, 20 is the N, 1,000 is the future value, and negative 1105.94 is our present value. So remember, there's 4 buttons in your calculator. We have to put in the 4, and you have to compute the 5th. Compute interest per year, and you should get, and let me do it in the calculator, 1105.94, change sign present value. 1,000 is the future value, 80 is the payment, 20 is the N, compute interest per year, and I get 7%. But you have to be careful So this 7% is what? It's for every 6 months. Because remember, you are computing for every payment every 6 months. So it's an annuity, which is a 6 months duration. We always report interest rates annually. So we have to say investors are demanding a 14% rate of return. Because if we were given to you at 14, what would you have done? You would have said, this is semi-annual, so let's reduce it to 7% for every 6 months. So that's what you have to be careful about when you're doing payments with different compounding. Okay, let's see the next step. From now on, let's just discuss some of the main features of these bonds. And that has to do with the fact that, we want to be very clear what the difference is between a bond and a stock. So, as it says here, and the book has it well written. So basically, bond is a debt instrument and there's no ownership involved, right? You're just a creditor like a banker. So as a result, you do not have any voting rights. Now, one thing that is different between a bond and a stock is when you pay interest to bondholders, thanks to the IRS rules or the government, the interest is tax deductible. So as you can find out later, that is a big advantage for companies to borrow money. Now, so therefore that means it is cheaper for companies. But do remember that creditors have legal recourse if interest or principal payments are missed. So even if you miss one payment, technically the creditor can go to the courts and say, he missed his payment or she missed a payment, and therefore we are going to take over the firm. So you're entitled to declare bankruptcy, and then you can take hold of their assets. And so from that perspective, for a company, debt is risky. And if you especially have excess debt, then the cost of your debt's going to go up because the chances of bankruptcy increases. So debt has to be used very cautiously. Stock, on the other hand, is the owner's capital. It's the owner's money, rather equity. And so as a result, it represents ownership of the firm. As we discussed in Chapter 1, common stockholders run the company by appointing a CEO first through a board of directors. They receive dividends, and that is not tax deductible, but the dividends depends on whether the firm has made a profit or not for that year. Now, what happens if they don't pay any dividends? Tough luck. You're owners of the company, so you may not get any money at that point. Okay, so suppose it's a firm that's all equity and no debt. Then technically nobody can declare default on it. The only thing that can happen is you have to declare default yourself and close the company down. But the minute you issue debt, do remember that you have opened up the possibility that if you haven't paid the interest or principal, that person or the creditors can come and take over your firm. Now, when the company issues bonds, there is usually a agreement. We call it an indenture agreement or a deed of trust. And it's a legally binding document, and it specifies all the terms and conditions of the loan agreement. So that's important. It's like, when you do go for a mortgage, you have the promissory note that you sign in order to get the mortgage from the bank, and which lists every detail, sometimes too much, about all the conditions of the loan. So that's called an indenture in the corporate bond market, especially. Now, one of the things, though, that's different between a mortgage, which is you and the bank, is that bank is only one person. Whereas when a company issues bonds, thousands of people buy their bonds. So for that, to resolve that problem, a trustee is appointed to represent the bondholders. And usually the trustee can be another bank, or it can be an individual that specializes in serving as a trustee. So what does the trustee do? The trustee is supposed to represent the bondholders and wants to make sure that all the terms stipulated in the bond are followed. They manage the sinking fund provisions that we'll discuss later. And then, of course, if the bond gets into trouble, the trustee will represent, because there are too many bondholders. And so you need a few people to represent the bondholders. Within the indenture, the terms of the bond are specified, and they include a lot of detail. Of course, the basic ones are: what's the face value? How much are the interest payments? When are they supposed to be paid? And there is the bond registered, which means is whether the ownership is recorded or issued in bearer form. So it used to be the case that bearer forms were popular outside because there the name of the person is irrelevant. But that, of course, can lead to all kinds of shenanigans, really. In other words, people didn't want to be recorded by the ones that owned the bonds. But in today's world, where everything is done electronically, the idea of a bearer bond is practically unheard of at this point. Within the bonds, sometimes collateral is offered. So if the collateral is offered, then of course you know what that means. It can reduce the cost of borrowing for the client, and also if you're the lender, you're a little bit safe because you know there's some security that's there in case the borrower is unable to make payment. Now, if the bonds are not secured, as we call them, in the US we call them debentures. Now, it's surprisingly in the UK, when you say the word debentures, it does mean bonds with collateral. So you have to be careful about terminology and where it's used. Another distinction between bonds is seniority. So some bonds have more seniority over the others. And when does this become relevant? Well, it becomes relevant when you are going for a default. So the senior bonds will get paid off first, followed by the junior bonds. Now, here's the issue on the sinking funds. The repayment terms can differ. So, for example, many cases, the bonds, let's say it's a 5-year bond, it will look like this: 80, 80, 80, 80, 80, and 1,000. So the full principal is paid at the end. But sometimes for longer term bonds especially, you know, you get worried that, let's make it 1 million instead of 1,000. Will the bank have all the 100 million or 10 million that it borrowed to pay back at the end of 20 years, let's say? So what you can stipulate is, listen, when 15 years is over, we like you owe us 10 million in total is what you borrowed. We'd like you to put 2 million, 2 million, 2 million in the last 5 years into an escrow account. So this way we know that the principal will eventually be paid back. So obviously if a company says, listen, we'll borrow from you 20, but I'll start paying you principal at 2 million each. I'll put it into an escrow account so that this way you know my principal will be safe. That's called a sinking fund provision, okay? That was actually established in the US in 1790s by Alexander Hamilton. And that's to assure lenders that the government will oblige its payment or will fulfill its obligations. And it's become popular ever since throughout the world. Another provision is the call provision, and this is the other way around. This is when a company can call back the bond. So if you want to look at the similarity with mortgage, it's that you can prepay your loan back. And of course, when will you do it? You'll do it when the interest rates come down, right? So if you borrow at 10% and suddenly the interest rates have come down to 6%, what would you like to do as a borrower? You'd like to go and tell the bank, listen, take my old loan back. I want to redo I want to issue a new loan, or I want you to lend me new and at the lower rate. So obviously this is good for the borrower, but not for the lender. So it's the same thing. Call provisions allow the issuer to call or repurchase the debt prior to maturity. So that means, obviously, if a bond comes with a call provision, the lender is going to demand a higher rate, correct? Because he wants to be, or she wants to be protected when the interest rates are coming down, but doesn't want to repay and would prefer that you continue to pay the higher rates. So hence they'll charge a premium when they issue bonds, or if you as a borrower issue bonds with the call premium. Okay, a make whole call will pay the current price of the bond and the different features. Sometimes they'll even pay more, but those are minute details we don't have to worry about in this class. So deferred call provision, or sometimes called call protection, says, listen, I will lend you the money, but you cannot give it back to me before the first 5 years. So this way I know I'll earn interest from you at least for 5 years. And then, of course, if the interest rates go down, you can give me back my, or you can, the borrower can call back the bond, and the lender will have to return the bond and take the money back. Protective covenants. Now, this is a whole day's class to discuss, but in the last 30 years, especially in the US, there's been all kinds of games played between bondholders, shareholders, and managers too. But basically what it does, a covenant basically says there are certain things that the company cannot do, and etc. So if you want to look at it in the automobile loan, for example, when you take a car loan, what does the bank say? The bank says you have to have comprehensive insurance. Right? And why do they do that? Because they don't want you to return back, or they don't want you to bang up the loan and then default on the loan, so that when they come to collect the loan or car and try to sell it, it's not even worth the amount of the loan. So you have to maintain the collateral at least to the face value of the loan. So those are some of the things that bondholders can demand. They'll say, listen, I'll lend you the money, but here are certain things you cannot do and certain things you can do. So, for example, we call them negative and positive. Negatives are the ones that say those are the things you cannot do. So you cannot pay dividends just as you please. You have to make sure you have enough cash, and you have enough cash to pay my loan first before you pay dividends. You cannot pledge assets to other lenders, that is, you cannot double count. You have to be careful you don't borrow too much lending. By the way, there's a game played, because companies always find ways to go around it. You cannot sell the main asset of a company, for example, a brand, one with a brand name, leaving the company as a shell. And recently also dealing with mergers and acquisitions. You cannot merge with another company and take on too much debt, because my value of my debt will come down. On the positive side, you must maintain working capital, make sure you provide us with audited statements every year, and maintain the collateral in good standing. So these are examples. The fine tunes are a specialization by itself. We don't even have to get into that. Now, in the US, when you are publicly traded bonds, you know, there's so many of them. How do you make out which is good and which is not good? Well, we have 3 agencies that have recently been battered in the image because of the financial crisis. but they are still around. S&P, Moody's, and Fitch. What they do is they are specialists in understanding the firm, checking their cash flows, making projections, and at the end of the day, they come out with the rankings that say, hey, this firm is solid, it's got a AAA ranking. Or this firm is not as good and it's a BBB ranking. And finally, you have, which we call below investment grade, so that's below BB. And then those are companies that they'll have to offer you a much higher interest rate if you have to lend money to them, because they may either have too much debt, or their business is shaky, or it's a fledgling new business, etc. For whatever reasons, they are not confident that the cash flows of this company is strong enough to maintain, the payment on the loans. The good news is there are enough people who are willing to take risk and who are willing to invest even in C bonds, but they'll of course get high interest rates. The default rates will be higher, but if you have sufficient of them, one or two defaults it will be okay, because you're making a lot more money on the other bonds. Types of bonds, well, we are basically the corporate and government bonds. As you know, government bonds are the US bonds issued by the federal government. These are US Treasury bonds. And then you, of course, have bonds at the municipal level. In the federal bonds, we have T-bills, which are less than 1 year, T-notes, which are between 1 and 10, T-bonds, which are about 10 years. Now, the interesting thing to remember is if you buy a US government bond, you don't have to pay state taxes. So if you earn interest, you're exempt for state tax, but you do have to pay federal taxes. And the US Treasury bonds is the global benchmark for what we call the risk-free rate. Even though occasionally S&P has lowered the ratings to AA, by and large, the bonds have remained AAA for the most part. So I'm actually going to change this and say it considered default, although S&P had lowered ratings to AA once. And I have to remember the year. So that would be just past the crisis, around 2010. I'm just going to put a question mark. Sorry, I did not update this. And now, I thought I had updated this one, but let me just quickly zoom. And federal debt, 2016. And let's see, it is 20.4 trillion. So you can see it's increased to around 20 trillion. And we can have a discussion on this. I hope it's 16, right? It's 17. They shouldn't have it. Oh, this is estimated. So that's not a good number. Let me just take a look at 16. It's 19.5, so let's be clear. 19.5 trillion is the debt. Moving on, and these are just things you can read, but I don't have to. Okay, I do not need you to do this. You can read all of this. I'm only going to do zero coupon bonds, bond markets. Don't need to use dirty versus clean pricing. So let me mark that down. For some of you who are interested, can do it. For this class, which you are mostly already middle managers above, remember MBA is a managerial decision-making course. I'm not so much interested in all the fine details of the math or the formulas, etc. I want you to just have a good rough idea so that you're able to understand, make budgetary decisions. If your company is going to borrow, at least you know what it means to borrow in bonds. The nitty-gritty details, you can leave it to the junior people to do. So I'm just going to talk about that. I do want to talk about the Fisher effect. So I'm going to click and just talk about zero coupon bonds, and then I'll go to the Fisher effect. So the zero coupon bonds are reasonably popular, and essentially what it is a company says, listen, I would like to borrow some money from you. I don't even want to pay any interest or principal during that period. Let me do the example that's in your, it's a 5-year zero coupon bond, sorry, and a yield 14%. So, you know, just lend me some money and I'll give all the money to you at one lump sum. Of course, you better have a good rating in order to do that. But let's say I agree, and I said, all right, I'll lend you the money, but you'll have to pay me 14% interest. So how do we find the present value? In other words, these payments are basically zero at this point. So same as before, you just find the present value of that. So you put 1,000 as my future value, 5 is my N, 4 is my interest per year. Interest per year. This time 0 is my payment, and compute present value. So let's see, 1,000 is my future value, 0 is my payment, 14 is my I, 5 is my N. Compute present value, it's 519.36. Why do I have a different number there? Oh, yes, I forgot. It depends whether it's a US corporate bond or a overseas corporate bond. In the US, this is good, rest of the world. So the rest of the world, it'll be 519.36. And these are what I meant by all the quirks in the bond market. But in the US, because most corporate bonds are issued semi-annually, then the computation is also done as if the payments are semi-annual. So you will have to use 1,000 as future value, 10 as the N, because if it's semi-annual, it'll be 10, 7 as my interest per year, 0 as my payment, and compute present value. In the exam, I will make it clear which version you have to use. So 10 is the N, 7 is the I, compute present value, and in that case, the price will be 508.35. So if you use annual compounding, it's this, semi-annual compounding is this. Okay. All right, moving on. And I said I'll move on. You can read the other types of bonds. They're not doing, is the Fisher effect. So the Fisher effect essentially is also called the yield curve, and that will be the final topic for the day. So basically, it's like as if grandmother came to you and said, you know, why is interest rates in the US running at 3 and 4%? And why are the rates in India running 8 and 9%? And in China, it's going at 13 and 14%. How do these rates in the first place get determined? So that's a good question, right? Because if you recall, in the Robinson Crusoe world, we said that if there is no demand for money, then the interest rates is going to be 0. The only time that interest rates go up, we know, is when you can use that money. And some people need it because they can generate more money out of it. So A can borrow from B $100 because he or she will use that $100, and hope to get 120. So this way I can return the interest and principal back. Of course, B could just consume that, but then you're not lending the money to a right person, you're going to end up in default. So the question though is then, in a Robinson Crusoe rule, how much should he or she charge? 10%, 5%? And of course that will depend on a couple of circumstances. But in a normal economic environment where there's continuous activity, and there's sufficient demand, there's enough people borrowing, enough people lending, there's a couple of things that should take place. Now remember, we have very low interest rates in the US, and Japan has suffered for many years with very low interest rate. Janet Yellen, in fact, is trying to move it to the magic number of 2%. And they are this year planning to increase it at least 3 times. I think they're going to overshoot. They shouldn't be raising it too much, but that's a different story. So the point is, so how do it? Well, the Fisher effect essentially says that the demand that comes will actually be based on 2 factors. One would be inflation, and one will obviously be the real opportunity cost, and we'll call that the real rate. But let me give a real corny example to highlight this case, and it kind of seems to stick to people's mind. It's the case, let's say you had $100 and you were planning to go out and buy 100 chocolate bars for $1 each. So you're a big chocolate freak and you had accumulated this $100 and you're right about to go eat. And just as you were about to step the door, again, I told you some of these corny examples, but these examples are corny, but it makes the point. What happens is, as you're about to go out, your younger brother comes in and is desperately pleading to borrow $100 from you because he has to go for a concert or whatever the case is at this point. Or it's your, we'll assume you're very young at this point. So you reluctantly agree to part with the 100 and basically postpone your consumption. And as you know in economics, when you postpone a consumption, the idea is that you will get rewarded for that in one way or the other. So in this case, you say, you know what, this is ridiculous. I've been lending money to him all these years. This time I'm going to charge him an interest rate. So how much should you charge? But let's say you know that the inflation rate is going to be 10%. So what does that mean? That means at the end of the year, the chocolate bar is going to be 110. So you're willing to postpone the consumption, but you say, I should at least maintain the same purchasing power. So I have to have 100 chocolate bars when I go. So obviously the first thing you're going to do is to say, yep, I'll lend you the money, but it'll cost you 10%. He agrees, of course, he'll agree to anything. But then you decide, and just before you were parting, you said, this is ridiculous. I'm postponing my consumption. You know, I was looking forward to having my 100 chocolate bars, eating it leisurely. But now, so I think this time I'm going to make sure that I end up with 2 chocolate bars. I want to have more chocolate bars when I get. And you decide 2 chocolate bars is good enough. So you want to have 102 chocolate bars at the end of the year. So in that case, obviously, what would you think? You'd say, okay, let me charge another 2%. So I'm going to charge him 12% interest rate. So let's see what happens. If he lends, you lend him 100, he gives you back 112. Is that enough? If you divide it by 1.10, because that will be what the chocolate bar will cost, it'll turn out that you did not ask him for enough. And what was the reason for that? The reason is you put 2% because you assumed the chocolate bar was $1, but it actually have to be $1.10. So the right formula is that we say 1 plus K, which is the nominal rate that we see in the market today, should equal to 1 plus the expected inflation rate. This is the expected because we don't know what will be the rate. Inflation rate. And 1 plus, we call this the real rate. This is the extra chocolate bar that you demand for postponing your consumption. So if you do that, then what happens is 1.10, 1.02, that will equal to 1.1220. So in other words, 1 plus k is equal to 1.1220, or k is equal to 1.1220 minus 1.0220, or 12.20%. So this is the rate you should charge in order to recover, to cover for inflation, and then at the least in an extra 2% or so. So you lend with the intention of increasing your purchasing power. Now, we have to be careful because, so when you look most of the time, I'm sorry, I'm jumping ahead. The Fisher effect. I'm mixing the Fisher effect with term structure. Let's be careful. Now, of course, that's the minimum rate. Now, if you're lending it to your brother who has a higher default rate, you're going to charge him extra premiums, etc., like that. And we'll get to that at one point. So that's the Fisher effect. It kind of gives you the minimum bound on how much you should lend. Now, I forgot, there's one more topic to be covered. The last one is called the term structure of interest rates, and it's related to the Fisher effect. We talked about a one-year bond, but in reality, what will happen is if you're lending longer and longer, you're going to be charging higher and higher interest rate. So the idea is this: we put here time, and we can put here yield. And what we want to show you is that this curve, which we call the yield curve, the formal term is term structure of interest rates. So if it's a 1 year and you are willing to lend to your brother for 12.20%, well, what if he says, I can't pay you in a year, I'm going to pay you in 2 years? Then usually you'll probably charge a little bit more. And if it's 3 years, you'll probably even charge more. And the idea being you're postponing your consumption for longer and longer periods of time. The other reason is also your money is tied up, correct? If you do need the money urgently, what are you going to do? It's tied up, you've lent it for 3 years. So we call that adding maturity premium. So in normal economies, the yield curve is upward sloping. So if you looked at this diagram, you'll see that there's a real rate, there's an inflation premium, and then there's a premium for interest rate risk, but also for many other risks. And the interest rate being risk being the interest rate could go up to 20%. And you could be saying, shoot, I lent to my brother 10%. If I had not lent to him, I'd have made a lot more money at this point for postponing my consumption. But let's stick to this part first. It's upward sloping. Once in a while, it comes to downward sloping. It happens very rarely, and it happens when you have very uncertain terms. This happened for us right after the recession, when the short-term market dried up and nobody was willing to lend short-term because nobody had any idea, so the short-term rates peaked up. So in terms of that, the short-term rates were even higher than the long-term rates at that point. So When we talked about premiums then, this curve can end up going higher and higher depending on a number of other factors for the bonds. So it could be even higher if we include default premiums, it could be higher if we include liquidity premiums. For example, lending to your brother is very risky because you know he never pays back, but lending to your sister is great because you know she's very methodical and she always studious and you can count on her to return the money. That's at the local level, but at the corporate level, if you're lending it to IBM, you know if you want to even sell the bonds, the chances are not only will it not default, but you're able to sell it as quickly as you have. So, so in other words, it's a very liquid market, okay? So once again, I do want you in this class to know the basics of the bond market. The computation is going to be very straightforward. It's asking you how to find the price of the bond, the yield on the bond, you know, at the managerial decision-making level. That's my goal for this class. So if you've understood how to price bonds, find the yield to maturity, and get an idea of the description of the bonds, that should be sufficient for me. Okay, with that, I'm going to close the class, close this chapter and move on to the next chapter. Thank you all.